can I just create a trust to avoid paying taxes? Welcome to another episode of our Crypto Expert series. I'm Jamie, your host, an award-winning crypto tax advisor within the UK and director of Myna Accountants. We have the wonderful Laura Knight, founder of Knightsbridge Tax, a bespoke consultancy firm specializing in international and crypto taxation with us today. Laura, welcome to the episode. Thank you for coming. Tell us a bit about yourself.
Oh, well, thank you for having me. So as Jamie said, I'm founder of Knightsbridge Tax. Background is actually private client, high net worth, non-doms, people coming in and out of the UK and specialising in crypto tax over the last few years. So trying to blend those two together.
Wonderful. So we will be covering a few bits and pieces today, and preferably in the area that we specialize in, obviously, Laura. And the first thing I want to cover with you is trying to debunk a few common myths, common misconceptions, if you like, that I get. The first one that I get a lot, mainly on TikTok, is, can I just create a trust to avoid paying taxes? Now, you might want to break this down a little bit more, I guess. But I suppose they're asking is, can I save taxes if I just put crypto into a trust? Maybe this is something you can help debunk.
Yeah, well, I can definitely tell you the answer is no. I think in terms of trusts, people see this because it's a separate vehicle. But by putting your crypto into a trust, the trustees, if you can find some trustees that will take the crypto and work with that, I mean, that's a practical issue in itself, would then also be having to report what was going on with gains and income instead. So actually what you've done is just change the person who's going to be reporting to tax. People do set up trust structures, predominantly though for inheritance tax reasons, because rather than having to pay 40% on your death, the trust is then only subject to tax. If it's a UK trust, it'll be every 10 years. So you have a up to 6% IHT charge. So the reason for setting up trusts would be for tax purposes, for inheritance tax, not actually for income and capital gains.
So in layman's terms, the answer is no. You can't do that to achieve what you're trying to achieve. However, there are other reasons to do so, i.e. inheritance tax planning.
Inheritance tax planning, and quite often people do it if they've got trading businesses because there are reliefs and reasons for doing it. But crypto, whilst you could do it, it's still going to have income and capital gains and reporting obligations.
It's perfect sense. So for anyone listening, stop asking that question, please. It's well known that it's not going to be particularly beneficial to you, not in the UK at least anyway. I personally find, Laura, a lot of people tend to cross American tax advice with the UK and they get a little bit confused and they try to do certain things that you can in the US but can't in the UK, for example. Now, the next question I get a lot as well is gifting crypto to children. Now, I always try to differentiate it between either having the crypto already and then gifting it, or just starting to build that pot of crypto for your child sort of live by acquiring crypto on an ongoing basis, maybe say monthly or something like that. Do you have any comments around this, maybe some practicalities or anything around that our listeners should know about?
I suppose on that is thinking about the different types of taxes that could bite for that. So if you've got an asset already, you've got crypto and it's an appreciated asset, i.e. you bought it for 10, it's now worth 100. If you're going to gift that to your child, you're going to have a capital gains consequence you need to think about because there isn't an exemption for that. So that's one thing to think about. If you're accumulating it as you go along, what are you doing? Effectively, you've got cash and you're saying, here's your cash and I'm going to buy it for you. So you're actually gifting cash, or are you buying the crypto at that point and then gifting it? So you're going to have to think about those kind of things, about the tax points for that. We have some complicated anti-avoidance rules in the UK, some settlements legislation, as it's called. You can't just gift things and retain some kind of benefit down the line as well. So that's another thing to think about. We already know that if you gift assets to children and that can return an income, if that's more than £100, that's then taxable on you as a parent. And then there's inheritance.
Is that £100 per year per child?
Per year, yeah. So, if it earns more than £100 per year, then you're taxed on that as the parent. There's inheritance tax to think about. Actually, that's probably the least of your worries, because if you're, for these sorts of things, as long as you can record and evidence it, then you're quite likely to be able to fall into gifts out of income. If you're paying a little bit out, 50 quid a month out of your salary, and you can evidence that and it's a regular payment, again, you should be able to get out of future inheritance tax. But actually, again, it's a gift. So do we need to be thinking about that? So yeah, there's it's not to say you can't do it. There's just some facts to think about. The other thing is, once they've then got those assets, if they are those assets in their own right for that child and they own those assets, do you want your child reported? They're going to have to file self-assessment tax returns if there is any trading going on. And it's an interesting point you said about the child thing there, because there are children who are out there actually earning their own incomes from part-time wages and buying crypto. And again, they're subject to having to think about self-assessment rules as well.
Yeah, it's a really complicated question when you break it down that way. And I just wanted to add a little bit for our listeners here. There is a difference between when a parent or a grandparent were to gift children or the grandchildren. Is my understanding that if you were to generate income from those assets, that would be, if you were to be the parent of the child gifting, that would be taxable on the parents until the children are of age, whereas the capital increase or decrease would be subject to the child itself, whether it's a capital gain or loss. If, however, grandparent were to give the grandchild the same assets, both income and capital would be subject to that child. So there's a slight...
That's exactly right. It's that parenting issue. And again, we're back to it's the settlement argument around, and it's looking at that, because obviously what some people were doing in the past was actually just moving some of their assets off onto their kids' names and then saying, well, that's not my income. And obviously HMRC are wise to that, and so they need to have these sort of things in place.
What age does the kid have to be before it becomes taxable on the child in terms of income tax? Is it 16 or 18?
18.
18. Wonderful. So the reason why we're bringing this up, guys, is because if your crypto were to generate staking rewards, as an example, that could be deemed taxable on the parent rather than the child itself. So please do be very careful with that. It's quite easily done. Another and the final sort of myth, if you like, and question that I get a lot is, if I just leave my ledger in a foreign country and I live in the UK, do I have to pay UK taxes? There's always some form of connotation around me flying to Dubai, dispose of the assets, or leaving my ledger there in a safety deposit box and then flying back and then it disposing at some point or generating staking rewards or whatever it might be to try and avoid taxes. Can we break this down a little bit? Because I know you're an expert in international tax rules as well as crypto.
Yeah, we do get asked this a lot in terms of this CITES question. And I think it comes from the fact that a lot of people feel it's not very fair, because if you have shares or accounts in offshore countries, there are specific rules here in the UK up to the 5th of April 2025 where you could have benefited from a scheme, a remittance basis scheme, where you wouldn't have had to pay tax if you met certain criteria. But that for crypto assets, we've got this anomaly in that we don't have any legislation about for capital gains purposes, where is the CITES of your crypto? And we have to look for each tax, we have to look at CITES differently. And so for capital gains, we have quite clearly set out in legislation where location of assets are. Crypto is not included. That's for capital gains. For income tax purposes, we don't. I mean, that's source. And where is that? And HMRC haven't provided any guidance on that. So that's kind of an outstanding out there. And in inheritance tax, we actually look to common law principles. So again, you've got the same asset, 3 taxes, 3 different issues for CITES and source. Going back to your question about can I leave my hardware wallet or offshore and I'm not taxed on it in the UK, the answer is no. And it depends. If you are a UK resident, UK domiciled individual, you are taxed on your worldwide income and gains. So actually, ignoring anything else, you're fully taxed on any transactions and any capital gains and income that you have worldwide. If you are non-domiciled, up to 5th of April 25, we've, like I touched on, we had these rules where you can elect to pay tax on a remittance basis if you meet certain criteria. So providing you do not remit those funds or income from those funds to the UK, you could benefit from this tax position. But the practicality of that is actually very different, in that if you have another wallet that you're using, got a non-custodial wallet, you're operating from the UK and you're interacting with a wallet that is offshore, again, that opens up a whole can of worms. And then if we go back to the fundamentals on this, HMRC say absolutely not. crypto assets are taxed where the beneficial owner is resident. So if you own those assets, you are taxed in the UK. Lawyers, advisors across this whole space, including STEP, actually, one of the bodies, Society of Trust and Estate Practitioners, have all spoken out about this because they don't agree with HMRC position. HMRC is a position, they've taken its guidance. They would have sought internal counsel on that or some position to have got where they've got to on that position. There's nothing legally that, states that is categorically the position. But should you go against HMRC's position, do expect an inquiry into that. And I think going forward, we're going to see a lot more inquiries on this case, on this position, because in the UK, since the 6th of April 2025, the tax rules have changed in the UK. And for those people that have been claiming remittance basis and not declaring their crypto assets because they feel there's a position to be taken that they don't agree with HMRC's beneficial owner rules, they are going to now have to declare their worldwide income and gains if they're still resident in the UK. So whether we're going to start seeing more cases on this. As a profession, we are expecting there to be some kind of case law coming out of all of this. We expect it to be tested. We've all been waiting for it. We haven't had it yet. But ultimately, the answer is if you are resident in the UK and your assets could even be deemed to be offshore or held on exchanges that are not UK exchanges, HMRC position is you are taxed on those in the UK regardless.
Domiciled individuals, so those who are born outside of the UK and come to the UK as a tax individual who's resident. So there's differentiation between residents and non-dom or domicile status, if you like, just to help you guys understand that if you want to go back and kind of re-listen to that, because it is quite technical, all of this, and it is aimed at those tax professionals at this point rather than necessarily the retailers. But any questions, always comment below and get hold of us, please do. So is there anything around that we need to touch upon, or would you like to dive into tokenization of assets perhaps? Yes,
so tokenization of assets, and you've just reminded me of another point that really ought to clear up on the CITES point. If your underlying asset, if you have a token and actually that's representing an underlying asset, for example, tokenized assets, tokenized bonds, for example, which we're seeing more and more being used, you have to look at the underlying asset for CITES purposes. So if you've got tokenized US bonds, for example, those are US bonds, they are not in the UK. So CITES for that purpose, for capital gains purpose, would be outside of the UK. And so the same with NFTs, and quite often with NFTs, you could have a mix of things. You may have, whether you've actually got pictures, whether you've got access to services, you could have a multiple of all sorts of things that could be part of that NFT. You'd have to look at the underlying assets. What does that token represent? So the point is, it's not an easy answer in some of this in terms of tax and working out what has actually happened.
Yes. So to recap, if something is tokenized, just because it is tokenized doesn't necessarily mean it is taxed at the point. Is taxed relative to where the beneficial owner is. So the rest of the crypto space is in relation to where the beneficial owner is, i.e. in the UK, with assets, crypto assets that are held on exchange in the US. Doesn't matter, you're taxed in the UK. If you have an asset where it's a tokenized version of something else, we look past the crypto element as if it's not there. And we just go back to the sort of what would normally happen in that situation, which is fairly straightforward when you think about it. Now, I've got a very unpopular opinion here, Laura, which you might not like, and I know many of our listeners will absolutely hate. I strongly believe that tokenization is an absolute gimmick, to be perfectly honest. I do not think in most cases it is necessary. I think in most cases people are trying to jump on the bandwagon. Now, if there is a purpose for tokenization, for example, quicker transactions, cheaper transactions, maybe a bigger audience of potential retail investors into that tokenized asset, whatever it might be, then that starts to make sense. Historically speaking, Laura, I don't think this has really happened appropriately up until lately, shall I say. Now that we're going into the tokenization of these US bonds.
Yeah.
Do you believe that starts to tick these boxes, my personal, requirement and criteria of Is it faster? Is it cheaper? Is it more trustworthy, perhaps? Are they starting to tick these boxes, do you think? Or am I just trapping
I
you
don't know.
into concurring with my opinion?
No, and I think a lot of it's around access. So typically, having worked in private client world with high net worths and ultra high net worths, a lot of them will use wealth advisors, and they will rely on discretionary managed funds, and they will have people buying and selling and taking these opportunities. And the markets are also open at certain times. One thing I think in terms of 24/7 access and a secondary markets on being able to buy and sell these kind of assets or tokenized versions of, that's the bit that I think is the sort of the crucial thing for how far this goes. There's also a CG argument, and I haven't spent too much time thinking about it, but probably should, in that particularly in some of the US funds that you might have, they would be offshore income. There should be offshore funds. For UK tax purposes, if they haven't got, there's something called reporting status and non-reporting status. It's all very technical, but ultimately, if the fund reports to the UK HMRC, you can have capital gains treatment when you buy and sell your interest in that fund. If they
So the
don't,
offshore pension scheme, that type of thing where it's been reported to HMRC?
it is different. It's got very set of specific rules about how the criteria is met. But if you have a non-reporting fund, they don't report to the UK HMRC, then your starting position is when you buy and sell those interests in those funds, you're actually subject to income tax. I mean, it catches loads of people out, and Americans that have come into the UK, we see it a lot. They're just used to having mutual funds as investments, and they go to sell them, not thinking they're going to suddenly be paying up to 45% income tax on the disposal of those assets. Actually, if you tokenize those assets, and now what you've got is a token, and you don't, because you're not taxing the underlying asset, you're taxing the token that you've got. Have we now got a capital gain position rather than an OIG position?
That goes against what we just said, where when we tokenize something, we look through it. But you're saying in this situation,
That's
we must.
for the purpose of CITUS. That's not for the purpose of tax.
There we go. Yeah. That's
So
the
I
link I was
wonder.
missing.
I haven't spent much time thinking about it, so do not quote me on this. But I think this is where there may be opportunities, for funds to tokenize possibly.
Laura, in Web3, we call this alpha. This is the front of the line headline news ahead of everyone else. So this will be captioned, Laura Knight drops alpha on tokenization of
Please don't follow me. You do not want to follow any of my investments. You really don't.
So we've got all the the disclaimers. None of this is financial advice. This is just two professionals having a chat about the crypto space. I should have called this series "Fly in the Wall" because that's exactly what it is. This is the sort of thing we talk about, off record on the phone, for example. So, okay, a couple of more questions left for you before we wrap up. Inheritance tax and crypto. Is there anything we can cover ever so quickly with regards to this?
Right. So I suppose what we need to be live to is that crypto assets are property for inheritance tax purposes. Part one is, do you have a plan in place? What happens on your death? So we know that there are a significant amount of people that will have accumulated wealth purely just from crypto. Now, they won't necessarily have wealth in other kind of assets, but they might just have crypto wealth. If you have an asset, if you have an estate over 325,000, which is the limit that we've got in the UK, it's been for however many years now.
It needs to increase soon. It really does.
Yeah, can't see that happening. Then you need to be thinking about whether you're going to have an inheritance tax liability. Now, there are things, spouse exemptions and things that might mitigate some of the IHT position. But you need to be thinking about your crypto. Where is it going on your death? Who can access that? Have you got an inventory? And if so, where would you even keep that inventory? You need to be so careful around security. Do you have something? There are solutions out there. I know that people are offering something up where you can encrypt information about that, so that on your death that can be accessed. Do you leave that with a solicitor who can act on your behalf? You need to be thinking about these things, because the problem would be is that if you have accumulated wealth that would be subject to inheritance tax, on your death, that is going to be you're going to have to pay that tax. If you can't access those assets, you're going to have a problem. And because of the asset class and how this is, a lot of people are maybe not talking to their partners about it and those people that they might be passing on the assets to. And maybe they never will, but you need a plan in place to have a think about it, because it's going to be a huge issue, I think, going forward. I know people where they have passed, it's having to go back into computers and phones and seeing what they can do and what can and can't be accessed. So yeah, it's an important thing to think about if you are accumulating crypto wealth.
So the headlines here are, with inheritance tax, number one, crypto is part of that scope. It just is. Number two, there is a certain amount of limit that you can pass on tax-free. However, a big proportion of that will usually be taken up by your home, usually speaking, on average, should we say, if not all of it. Number three, have a plan. Because of all this, you need some form of plan. How do you pass that on to the next generation? How do you pass it on to your spouse, for example? So realistically, the answer is, think about it, talk to an expert, get lawyers involved, especially if you are on, and I know it's a morbid topic, but if you're on your sort of if you're expected to last less than 7 years, you definitely want to get this involved, get lawyers involved and start tax planning for inheritance tax purposes, because with potential exempt transfers and all sorts, in the mix of all this, on top of everything else, it can get quite complicated. So it's certainly something to perhaps talk to Laura about, and or a lawyer, I would say, if that's the case.
I'd say, and watch this space with the government as well, because potentially exempt transfers. So if you gift an asset and you, at the moment, as long as you survive 7 years, that falls out of your estate. I wonder if it'll be one of the things that Rachel Reeves goes for in the future, because obviously it's there is a number of these kind of scenarios around IHT that they're reliefs. So thinking about it now, making some plans, just being alive to the fact that this is an issue. And the other one is, if you're thinking about leaving the country, you're fed up with the UK tax system, particularly on your crypto, the compliance is a headache, we're done with this. If you've been in the UK for more than 10 consecutive years, that inheritance tax tail follows you for another 10 years, wherever you may be. And I'm sure people will be, well, how are they going to find me? Because we get those questions all the time. And the answer is, it's an obligation, it's a responsibility. And yes, maybe how will they? But when you need to be off-ramping this crypto, and we've got a lot of reporting measures coming in with the crypto asset reporting framework in the future, these are live issues. So don't forget about inheritance tax if you've accumulated a significant amount of wealth in crypto.
Yeah, very important. It's just an absolute minefield. Well, tax is on its own. Crypto is as well itself. Now, when you've got the two together, you are really talking about a recipe for disaster here. And final official question for you is, do we have any call to actions for you, Laura, before we do sign off with the final question, which you have no idea about? But I'll really subject you to it anyway.
I'm a bit nervous.
Anything for the call to action?
Yeah, so I have a real issue at the moment around client data from exchanges. Trying to get data, retail data, is tricky. And there are some platforms who are refusing to provide that data if you are UK resident when you originally signed up. But actually now they're not acting for UK residents. Getting good quality data from crypto exchanges is absolutely key to being able to be fully compliant and being able to complete your taxes. And if anybody is watching and has those abilities, I really think we should all be pushing for this. We've got, as I've said, crypto asset reporting framework. 50 countries have signed up. So from next year, they're going to be starting to record your data on you, and then reporting across those 50 countries are in 2027. Those exchanges will have to report to the governments, but they actually don't have any requirement to report to you as a retail user. So if we can all keep making this noise about it and hope that we can move something, because at the moment there's nothing to really compel them to have to do it.
You've been very clever to sidestep name dropping these exchanges, but I'm happy to. Binance, sort it out. Mexi's the worst out of all of them in terms of obtaining data, and I'll say that outright because those are facts. Now, without that information, it is virtually impossible to deal with the bookkeeping, therefore it's impossible to get the taxes right, etc. So I find it absolutely ridiculous, Laura, that we are talking about Web3, which is about the ownership of your data and taking back control, where these big Goliaths within the Web3 space are not giving you your data when it's in Web3. It just doesn't make sense to me whatsoever. I understand that it's to do with the FCA blocking the ability to use some of these exchanges, perhaps, but the access to data should be there regardless. I think you're absolutely right. And I could go on about this for another hour because it absolutely
I am
boils my
100%
blood.
with you. I'm with you on this. And obviously, and as we've spoken about, we do converse about these issues. Finance being one of them, in that, you know, you can get a CSV download, you can get an API download and still be missing a load of transactions. I mean, that just shouldn't be happening. Going forward, let's hope that because of the reporting requirements that the data gets better. But for historical positions, which is pretty much every client that we see, it's not okay. Come on.
The amount of times I've had to put down in a white space note, this basic to the tune of, this is the best we could do, like with the data provided. There's nothing more. Laura, thank you so much for coming on to the show today. Genuinely, it's been a pleasure. Very technical today, which is great. You know, I'm always looking to up the technical sort of content within all this for those accountants or those practicing more so than retail investors. So I'm sure this will help both. However, the final question before we do sign off, Laura, is what are your market predictions in the next sort of 12 to 18 months? Do you have any sort of hopes of something going up or maybe going down if you're looking to short something? Maybe you've got some form of inkling about regulation within the UK. Just any predictions within Web3 and crypto?
Oh, so I'm probably more on the bearish side of all of this. I'm not sure we're going to get the bull run that everyone thinks that, you know, is going to happen going forward. And I don't think it's because it's not deserved. I think because of the macro environment that we find ourselves in, with sort of global wars and issues with financing full stop, that actually that causes a much bigger issue for what should have been or could have been. So whether we get that, I mean, I hope for my own personal investments that does happen, but whether that was, pretty bearish on it. Regs wise, there's regulation coming out left, right and centre. I think it's good, providing it doesn't stifle the market. And I still am concerned about that. Consumer protection is absolutely paramount, and I get that. But I am still concerned, particularly when you see things coming out around, you know, you can't use a credit card, you know, that suggested you might not be able to use credit card to buy a stable coin, to buy anything that's not a stable coin. Will you just buy a stable coin and then convert it? So that to me made no sense. So I'm hoping that there's opportunity for regulation that can better service like this whole market. I still think we're going to be red taped for quite a long time.
No, great insight. If anyone disagrees, please comment below. I might comment myself, but this is exactly what we have this conversation about. It's personal opinion, none of it's financial advice. Laura, Once again, thank you for joining us today. Genuinely, it's a pleasure hosting you. Yeah, hopefully we'll see you again on this channel. If people want to see this type of content, let us know and we'll do some more. If not, I'll speak to you on the phone at some point, Laura. Cheers.
Thank you for having me.